Welcome to This Explainer. Today, we're unpacking the surprisingly complex, and honestly kind of wild, legal and business mechanics hidden right behind the glitz and glamour of live entertainment. I mean, when you're sitting in a dimly lit venue enjoying a killer performance, the absolute last thing on your mind is tax law, right? But as we're going to see, just one simple gesture from an adoring fan can set off an absolute avalanche of accounting and legal obligations behind the scenes.
To truly understand the life cycle of a tribute gift, we're going to peel back the layers of this iceberg. We'll start on the stage with the tribute gift illusion, figure out who makes the sale, dive into the hidden GST trap, look at backstage income tax rules, tackle non-resident withholding tax, and wrap up with the ultimate compliance takeaways.
All right, part 1. The tribute gift illusion. More than just a simple gesture.
Picture this setup. You've got a fan in the crowd who really wants to show their appreciation for a fantastic performance. They're having a blast, the music is pumping, the energy is through the roof. So they decide to buy a tribute gift for the performer right there at the venue, handing over a hefty $500 to make it happen. Now to the fan, and probably to the performer too, this just feels like a super generous showing of appreciation.
But here's the $1 million, or, well, $500 question. Is it just a voluntary tip? Nope. What seems like a totally simple, generous gesture actually triggers a massive cascade of tax obligations for the business collecting the money. You see, tax authorities absolutely do not look at this as just handing a performer a bouquet of flowers.
Legally speaking, it's not a tip. It is officially considered a tribute gift sale. Under the GST Act, this is defined as a taxable supply of a service. So when that fan hands over their cash, they are literally paying for the right to publicly honor a performer and to partake in the whole entertainment experience provided by the venue. It's a service transaction, plain and simple.
Which brings us to part 2. Who makes the sale? The control room.
To figure out how this whole thing is taxed, we first have to answer a really critical legal question. Who is actually making the sale? Are they the principal, or just a collecting agent helping someone else out? Well, if we compare the venue's control against the performer, a pretty clear picture emerges. Look at the venue. They manage the whole shebang. They make the gifts available, set the prices, collect the payments, and decide how the cash gets distributed. They control the acts. Now look at the performer. They generally have zero say over any of this. They don't set prices, they don't collect the cash themselves, and they don't even determine their own cut.
So the crucial point is this. Because the venue exercises so much control over the sales process and the performers, tax authorities treat the venue as the principal making the supply. The venue isn't just a middleman or a collecting agent acting on the performer's behalf. Legally, they are the ones making the sale.
Okay, moving on to part 3, the hidden GST trap, following the money. Since the venue is the principal, we have to look really carefully at how the goods and services tax, GST, is applied to that cash. Let's go back to our $500 example. Let's say the venue decides to keep $300 of that gift and passes $200 on to the performer. Basic logic might make you think, well, the venue is only keeping $300, so they only owe GST on their $300 cut, right?
Actually, scratch that, wrong. And this perfectly illustrates a major compliance trap that catches so many businesses off guard. GST applies to the entire $500. It literally doesn't matter how the money gets sliced up behind the scenes. That full $500 is the amount paid for the service, so it's the full value of the taxable supply made by the venue as the principal. Assuming you only owe GST on your cut? Yeah, that's a fast track to an underreporting nightmare.
All right, part 4. Backstage income tax rules. Creative accounting dangers. Moving from the stage to the backstage books, we've got to address how this money is treated for income tax. And honestly, it's pretty straightforward when you play by the rules. Every cent of revenue earned from these tribute gift sales must be recorded as part of the venue's gross income. Yep, that full $500 hits the top line. But hey, the good news is that the $200 paid out to the performer, whether you frame that as a salary or a share of the sales, can actually qualify as a deductible business expense for the venue.
But I do want to issue a quick insider warning here. Tax authorities are actively hunting for venues trying to get a little too creative with their accounting. They've seen cases where venues try to artificially split this income across multiple entities operating from the same building. Like maybe trying to push tribute gift revenue to a separate shell company just to avoid hitting the GST registration threshold, while the main venue still pulls all the strings. If that setup lacks a real commercial reason and is just there to dodge taxes, well, tax authorities legally regard that as tax evasion, and that carries some truly severe penalties.
Let's look at part 5. Non-resident withholding tax, the catch with foreign talent. So let's add another layer and see what happens when the performer getting the money isn't a local resident. A ton of entertainment venues bring in foreign talent, right? Well, you can't just treat all foreign workers the same when it comes to withholding tax. Check out this breakdown. A singer, dancer, or stage actor who steps into the spotlight falls under a very strict, specific public entertainer tax regime. Their salaries and their share of tribute gifts are absolutely subject to this withholding tax. But let's say you have an independent foreign musician brought in for a one-off gig, or a sound engineer working in the shadows. They might not meet that public entertainer definition. Their income could fall under a totally different withholding tax category, like non-resident professional or contractor payments. That means different rates, different filing categories, and different exemption thresholds. You literally have to assess every single gig based on its specific facts.
And for those who do actually qualify as public entertainers, the compliance clock is ticking loudly. Venues are legally required to file and pay this withholding tax to the tax authority by the 15th of the second month from the date the non-resident performer is paid. Miss that deadline, you're looking at some totally unnecessary penalties.
Finally, Part 6, the compliance takeaway, the encore.
Okay, let's pull all of these hidden layers together so you know exactly what to take away from this explainer. Here are your golden rules. Number 1, GST applies to the full value of the tribute gift, not just your cut. Number 2, income tax applies to the total gross revenue. Number 3, you can treat those performer payouts as deductible business expenses. Number 4, withholding tax means you have to accurately classify whether your foreign talent is a public entertainer or something else. And number 5, probably the most critical of all, your contracts and your record keeping have got to be rock solid. Your contracts absolutely must reflect the reality of the transaction if you want to avoid disputes with tax authorities down the road.
So the next time you're out having a great time and you see an excited fan hand a tribute gift to a performer on stage, you kind of have to wonder just how much invisible tax math is happening in the control room at that very second. The glitz and glamour you see on stage are actually built on a pretty intense foundation of strict rules and meticulous accounting. Thanks for joining me on this explainer, and definitely keep your eyes open to the hidden mechanics happening all around you.